Recession. The word alone triggers visions of plunging stock markets, financial instability, and economic hardship. However, history has repeatedly shown that financial markets successfully rebounded after the worst recession-led sell-offs, and that thanks to the central bank policies that aim to stabilize the financial markets and boost economies through an efficient set of monetary policy tools. So welcome to this educative episode, guys, where we will discuss in detail about how central banks around the world overcome economic weakness and why sometimes bad news are perceived by investors as being good news. So yes, I know recession is never a good thing for anyone, and the rising recession expectations never sound appetizing for anyone because recession means economic contraction. It means contraction in the economic activity, declining earnings and falling profits for companies, and the latter is not good for stock valuations. However, the reality is a bit different from that, happily, because yes, recession is never good, but there are mechanisms in place right now to help the financial markets navigate through hard times. This is why you will often hear analysts say, bad news is good news. You know that word, right? Bad news is good news. So that means that bad news boosts the expectation of support from the global central banks and could very well act like good news at times when investors are losing appetite. So let's dive into that. As I said, one of the most critical factors supporting the financial markets around the world during hard economic slowdowns is the intervention from the central banks. That's very important because when economic activity weakens, central banks have the job to step in with what we will call monetary policy easing. So monetary policy easing includes cutting the interest rates, purchasing government bonds, and ensuring liquidity in the financial system to not make the things worse. On the contrary, to improve things in the market. So these actions are designed to prevent a credit crunch and stimulate financial conditions to improve the economic conditions as well, which in turn can fuel a market rally even as economic data deteriorates. So take the 2000s dot-com bubble, for example, as an example, because we often hear these days parallels being drawn between the recent AI rally and the dot-com bubble. So at that time, in 2000s, the US economy indeed entered a recession following the bursting of the dot-com bubble. So that was terrible. The market valuations tanked and the economy contracted. However, the stock market actually bottomed in late 2002 and began recovering well before the US economy did. And this is because the Federal Reserve aggressively cut the interest rates, eventually bringing them down to 1% by 2003. So these actions set the stage for a multi-year equity bull market despite lingering economic weakness. And at the end of the day, equities tanked when economy was doing just fine, and they recovered after the bubble burst. So the bursting bubble actually sent the US economy into recession, yes, and the Fed brought that much needed relief to the financial markets, helping stocks to recover. Then, as a result, the economy followed suit. And that's exactly what the Fed wanted. This is exactly the Fed's job. Why? Because lowering interest rates at a time when things are not going well, makes borrowing cheaper for businesses and for consumers, stimulating investment and spending in an economy. Additionally, falling interest rates also reduce the discount rate used in valuing future corporate earnings, as such making stocks more attractive in terms of valuation. So that's simply a mathematical certainty, a mathematical reality. Historically, markets have often responded positively to interest rate cuts from the central banks, particularly when they are aggressive and proactive. Really, tell investors that dovish expectations are on the rise. The first thing that they will do is to go out and buy stocks. This is how bad news become music to investors' ears, especially in hard times. Bond purchases, on the other hand, often referred to as quantitative easing, yes, QE, has first been used by the Bank of Japan in response to prolonged economic stagnation and deflation in Japan following the collapse of Japan's asset bubble in 1990s. Now, while the Bank of Japan's efforts had limited success initially, back then, quantitative easing became a widely adopted monetary policy tool during the 2008 financial crisis when the US Federal Reserve and other major central banks, including the ECB and the BOE, deployed large-scale bond purchases to stabilize financial markets and support economic recovery. So it basically means that the central banks of the Western economies buy the bonds, so the debt, the government debt that their respective governments issue. And because they buy huge amounts of government debt, the demand keeps the yields, the government yields, hence the borrowing cost under pressure. It is magic. I'm telling you, obviously, you must be a major central bank to benefit from this magic, because if the central bank of Turkey, for example, starts printing money to buy the Turkish government debt, well, it won't necessarily work. So yes, life is unfair, but the QE works just fine for the economies like the US, Europe, and the others. So yes, for those who are lucky enough to benefit from the magic of QE, it is an excellent way to inject cash into the financial system and keep bonds and bond yields in a good shape. And we are talking about huge amounts of government debt purchases here, tens of billions of US dollar worth of government bond purchases, for example, in a single month. And that liquidity actually allows the global markets, especially the Western ones, again to rebound after a big financial crisis like the global financial crisis or COVID, for example, where we see the markets record a beautiful V-shaped recoveries, rebounds right after the initial plunge. So that's beautiful. And even if the Fed's massive balance sheet is sometimes criticized by economists, and the fact that it will never go back to levels pre the global financial crisis and even the pandemic, well, pops sometimes as an issue as long as policymakers ignore the problem and as long as investors are happy about these purchases and they are happy, I'm telling you, well, to ignore the Fed's balance sheet issue, because withdrawing that much liquidity from the global financial system is just unthinkable at this point in time. Well, this whole system is going to remain in place and it's going to help the financial system to stabilize. And we know that in the next crisis, whenever it will pop, the Fed will be there to lower the interest rates and buy bonds to stabilize the market. So you probably heard that the first thing that the US Federal Reserve has actually done to react to the recent sell-off triggered by the tariff uncertainty from the Donald Trump's administration was to slow the quantitative tightening. So this might sound a bit strange to you, and especially if you are new to the financial markets and to the way the markets function, but it will help you understand why. But why the sight of an ugly GDP number, for example, or a market sell-off, well, could trigger a market rally, and why a piece of strong economic data could, well, eventually upset investors. It is just about perspective. Investors see lower interest rates and bond purchases in bad news and in bad times, and they see higher interest rates and quantitative tightening in good data and good times. So voila, this is why the way the market reacts to the news that surround us actually depends more on the central bank expectations with regards to the economic data and to the news than the data and the news themselves. So the next time you watch a data land or a market sell-off, ask yourself how the economic data or how the market sell-off will impact the central bank expectations around the world, the rate expectations, and hence the yields. And you will actually see that bad news tend to trigger market rallies at some point in time more often than they trigger market sell-offs. So this is all for this educative episode of Market Talk. I'm Ipek Ozkardeskaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on our new WhatsApp channel, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again shortly, and until then, good day trading.